Okay, good morning to each of you, members of our Family Business Learning community. I'm Sally and I lead our team at the Family Business Center. And I'd like to welcome you to the third webinar in our series that we're producing to help you navigate the many uncertainties that we as business owners face due to COVID, which is unfortunately part of our reality. Well, this is new terrain for all of us, but crises are not new. And so now's the time to really step up our leadership and surround ourselves with some wise counsel. We remain committed to surrounding you and supporting you. And as we've had Zoom meetings and phone calls with some of you, we have just been inspired by how you are taking care of yourselves, first of all, putting the oxygen mask on you first, and then caring for your family, your businesses, and your teams. Want to note that we are recording this webinar. We will send it out to you afterward, both an audio and a video. And we will also send you any documents, slides that are being shown on this webinar. We will also be taking questions throughout, and Jared's going to explain to you now how to raise your questions.
Yeah, so if you're new to Zoom, although that's probably less and less of a thing now since everybody's on Zoom, but at the bottom, if you're on a desktop or a laptop, at the bottom, sometimes you have to actually scroll down or up for it to come up, especially if you're on a tablet or a phone. But if you're on a laptop or desktop, that Q&A button will be at the bottom, and you can just click the button that says Q&A, and a new window will pop up, and you'll be able to ask a question and submit it. So I'd encourage you to do that. And then I would encourage you not to use the chat function, only because it'll be on the side. It'll be harder for us to get, and it could be a distraction for everyone. But if you use that Q&A function, only we'll get it. You can ask it anonymously. There's a button for that. If you're on your phone or a tablet, it'll probably be at the top, and you may need to touch the screen for it to come down, and then you can click there. So yeah, we would encourage you to ask your questions, and we'll be answering those throughout our time at different times.
So today the topic is what's up or down with the stock market, my retirement plans, and my estate plan. And I know many of you are coming with different hats on. You're on different mountains as a family member, a business leader, shareholder, maybe even on the board. Now, our presenters haven't been through a pandemic before. They have been through economic downturns and other crises. Jared and I work closely with both of our presenters. They're great guys. We like them as people, and they're experienced in their fields. Ian is going to be going first. You want to raise your hand there, Ian? And Ian actually is trained as an engineer, but I think loved people too much to stay in that. He navigated his way, actually started his own business in 2003, I Am Wealth. And he and his team provide comprehensive financial services. We love working with him. He's a great teacher, and he makes it fun. He always laughs when I say that. And we'll also be hearing from Mike Moransky from Fox Rothschild in Plymouth Meeting. Worked with Mike for many, many years. He's very seasoned with all kinds of tax planning, estate planning, brings a lot to some challenging cases as well. So we really enjoy working with these guys. And I'm going to turn it over to Ian to start us off.
Good morning, everyone. Can everyone hear me? Yes? All right. Excellent. Unprecedented times. It's about the best way to say it. True. I've never been through a pandemic. I don't think anyone on this call has been through a pandemic of this size. We'll go through that there have been some other similar health issues around the world, not to this extent, obviously. So we are in all uncharted territory. Our businesses are suffering, the economy's suffering, the stock market's suffering. My wife would tell you she's suffering while she's homeschooling, but there's different versions of suffering. I hope everyone's safe and healthy as we kick off here, and that's the bottom line. So, we're going to make light of this as much as we can today. We're going to try to make it fun, although it is a very stressful time. And my hope is that at the conclusion of the things I'm going to go through, you feel a little bit better about, what's happening and why it's happening and some things that you can do about it. So to just jump in and say what's happening, as far as the stock market and the economy are concerned, we have three basic things that have all come together as a confluence. We have an overbought stock market, which crescendoed at about February 19th of this year, of 2020. On top of that, we have an oil crisis, which is not getting any headlines at all, predominantly because the COVID issue is such a larger issue. But we do have an oil crisis that's happening, which I'll touch on briefly. And then we, of course, have the coronavirus, better known as COVID-19, as we've named it today. The three things coming together have caused an unprecedented just pile of you-know-what that has kind of affected all of us. And the question is, what do we do about it? And how do we get our heads around what to do next? So the good news is that this is not an economic crisis. It's a health crisis. And I say it that way because we did not have economic problems coming into this. I mean, coming into, February 19th, when the sun was shining, we had unbelievable unemployment, all-time lows. We had a very strong economy measured by any economic measure you can, GDP, economic production in any which way. And the good news about that is the stronger you go into it, it's much like if you ever had a surgery. Your doctor's going to tell you to go into PT and be as strong as you can before you go into the surgery. If you have to get your knee done, for example, well, that's what we did as an economy. So theory says that the tailwind of that will help us on the way out. So I'm going to share my screen now. This is a little something I showed on a different presentation. Hopefully we get a chuckle out of this, and I'm not trying to make light of the situation at all, but the point is this. There's always been something out there that was going to hurt us in some way, shape, or form, right? The short list of things that have killed us all. It was Y2K. We were going to flip over that 2000 mark with technology, and all of our computers were going to stop working, and the government systems were going to stop, and the IRS was going to shut down, and all these crazy things were going to happen. All the way up through different things that were diseases that were going to catch us throughout the world, et cetera. And the moral of the story is none of those ended the human race. And I don't believe that the coronavirus is going to do that. We've all seen press conferences by the White House and Dr. Fauci and Dr. Birx and everyone get up there. So I'm not going to get into that as much. But the issue is there's always been some reason why the next big bomb is going to drop, and it's going to be different this time. It is going to be a little tough, but I think we can get through it. So the question is, what does that look like? Is it going to be a V shape where we go down and we come back up? Is it going to be more of a U shape where the bottom of that kind of is flat for a little bit, so it takes some months or maybe even years to come out of it? Or is it going to be what they call an L shape, which means that it's going to take many, many years at the bottom before it eventually comes up? We don't know, but we'll talk about some hints as to what that could look like. So talking about the health component first. And once again, I'm not going to belabor this. We've all been through this to a bit. Testing. The denominator has been wrong since the beginning. This is my personal opinion. The fatality rate there is not right. The amount of cases that we know that are outstanding is not correct. And all of this information is very important because the economists and specifically the stock market, which I'll speak to today, are making decisions based upon a false narrative. It doesn't mean that it's a hoax. It doesn't mean that it's not real. It just means that the fatality rate and the hospitalization rate is much, much lower as a percentage of the cases than we believe it is. And hence, in my belief, maybe the stock market should have shut down from the beginning because all the data that we're getting is wrong. But we're past that point at this point. Drugs. It's not going to be a vaccine most likely because we are not going to inoculate healthy people with something that could potentially hurt them. So we have to measure the safety. But the idea of this is that we have to get a drug, which I'll get into, and I think my personal opinion, I think that a lot of what's been designed around the solution of the cure is based upon the hope that a drug's going to come to market sooner than later, which I'll talk about. So let's get into the economic component. When we talk about the history of the stock market a bit here, and then we'll bounce back and forth with the economy. As measured by the stock market, you can see that there have been different health crises, right? The Asian flu, the Hong Kong flu, Indian smallpox. More recently, we get into the thousands where SARS was a big issue, the swine flu. And what I want you just to quickly look at is look at what the stock market did, right? We had the stock market selling off, going into the problem. Then at the bottom, when the crisis really hit, then we have it popping back out, which I'll address later. Then we have over here the Singapore, then we have the avian, then we have the swine flu, then we have the Ebola. So there's always been some reason why something's been happening around the world, and these things seem to be more prevalent. But every one of those times, the stock market went down and bottomed as measured by the S&P, and then it popped back up, came back down, popped back up. So it's not like these were any, I'll call it kill shots for the stock market. These were more just temporary setbacks, and as long as we could weather the storm, we would come to the other side of that. The good news this time around, and this is just a piece from the SBA website, is that the government has stepped in, the administration, Congress, the Federal Reserve. They are trying to help us. It's everything from the stimulus check that each one of us are going to receive as long as we're not over certain income limits. That applies to everyone. Unemployment rules have been relaxed, and those unemployment checks have got much larger. We have programs like the PPP program, which is the Paycheck Protection Program. We have things like the EIDL programs with the $10,000 advance on the disaster recovery loans, et cetera. The difference between now and these other times is that the government has stepped in much, much sooner. So we may be behind the curve on addressing the issue, but we are definitely stepping in sooner in relationship to the issue as far as helping to save the day by getting money in people's hands. Because the government, whether it be, once again, the administration, the Fed, or Congress, and every market watcher knows that the longer this goes, the worse the problem, and that longer is exponential. It's not linear, which means that every week that passes by is going to be a steeper portion of that curve. So that is what's different this time. We're all trying to get back to normal. The only question is, what is normal going to look like? I, for one, feel like the best analogy I could come up with is when we finally turn things back on and we get back to going to sporting events, we get back to going to restaurants. People aren't wearing masks all the time. I believe that much like 9/11, for example, after that issue happened, when we got back to, quote, normal, it wasn't the original version of normal before the crisis hit. But there is a slow recovery of what becomes normal over time, to the point now where most of us don't think much about getting on an airplane since 9/11. But time will have to play out. I'm one that thinks we get back to being human. I don't think that handshakes and hugs are done, at least not for me at some point. So when it's safe to do that, I think we'll get back to it. But it will scare everyone in the meantime, and we will get back to some normalcy here. So going back to my analogy, I believe it's more like a light switch with a dimmer. So when we finally say it's okay to get back to business and you flipped on that light switch, yes, the switch has gone on, but what is the level setting on the dimmer? And I think that the level setting on the dimmer is probably going to be low to start, and then it's going to rise over time. So that goes back to the V-shape versus the U-shape recovery. Personally, I'm in the camp of a U-shape recovery, or a maybe not quite U like this, but maybe it's a softer V, let's call it. It's not this sharp V. Because I just think that we're going to get back to maybe an 80% economy, where some businesses definitely, some industries potentially, maybe don't have pent-up demand, and maybe even worse, are going to get wiped out in this. They just can't withstand, the storm, as we all know. And I'm hoping that's none of the business owners that are on this call. I'm hoping that, for all of us, we can withstand that storm. So along those lines, if you haven't taken advantage of some of these government programs, please go out and do it. I've been on many webinars. I've given many webinars. I'm more than happy to speak with each and every one of you about this. If you have any questions about, should I do it? How should I do it? How do we coordinate with your other advisors to do it? Steve Mnuchin at the top of that list, as Treasury Secretary, is encouraging every business owner to do it. I just put in my application for the PPP yesterday, and it was accepted through the system at my bank, which I bank at TD Bank. It doesn't mean that I got the money yet, but that process is in the works. So please take advantage of it. So, when we get back to the medical piece, we're going to flatten the curve. We're going to take a look at what this looks like. We may have to lock down more states. This may go into May. It may go into June. It may go as further than that. I'm not quite sure. I'm not a medical professional. But I think some things on the recovery would have to be addressed in addition to the health issue, which is the liability issue. And actually, Mike, you brought this to my attention, which is totally true. When we turn the lights back on and it's time to get back to business, how does an employer, most of you on this webinar, that is, say to your employee, it's time to come back, without the certainty that you can't get sued or there's some liability issue from the legal world if someone gets sick or passes away, God forbid, who comes back to work. So my point is, we have a long road to hoe here. And as Trump said on one of his press conferences a couple of days back, there's going to be a very, very big decision to make at some point, and we're going to hopefully make that decision properly. The last thing I'll say about the recovery is, I think that the thing that we need to avoid at all costs is going to be a double hump. As we've all seen, instead of the curve being like this, we're trying to flatten the curve. The worst possible scenario is that we turn the economy back on, which means people getting back together, economic activity ensues, and then all of a sudden things come back. And when they come back, we have another hump, because that would be a situation where the US Treasury has kind of shot its cannon. We have the Federal Reserve that's done the same thing, and I'm not sure how much ammo is left in that tank. So that would be, a very devastating blow to the US economy. I don't think that's going to happen because I don't think they're going to allow it to happen, but that may mean that we're out for longer instead of being out for shorter, which none of us want to hear, but it may be the right thing. So that goes back to, is the cure worse than the disease? At some point that could logically be the case. All right. So getting to some of the stock market things here. This is a chart of the S&P 500 from 1987. And I'm going to draw some parallels today to what's going on in the stock market today versus 1987, because I think that's probably the best one-to-one relationship if we can compare. Why I'm showing you this is just what the pattern looks like, not necessarily what the pattern was at that time as far as loss. But this is very typical of what we believe is going to repeat itself. And we've already seen a piece of this happening in real time. Whenever there's going to be a high market that's overbought, as it was in 1987, once again, as it was coming into February of 2020, you have this initial, what we call a whoosh. And the whoosh, technical term, means that you have this panic selling that just goes straight down like a rock. That whoosh ends up bottoming at some point. Now, why is that happening? It's happening for a few different reasons. Number one, you have a market that's trying to put a price to everything. You know, imagine if you had to value your business on a daily basis, value your home on a daily basis, value your cars on a daily basis. Those values would likely be all over the place. They would not be a smooth curve. It would probably be very jagged as far as that goes. The stock market doesn't have the luxury to look over time and value once per year. What it does is it values daily. Well, when there's misinformation or confusion on information, the case count, the fatality rate, what's happening, why is it happening? Those things usually come and people sell to get down to some point, because people say, I have no idea what the price is. I'm trying to find one, and I'm going to keep on selling until finally I feel comfortable. Well, when you have people looking around at each other, not knowing what's happening, it becomes a herd mentality. And it's just like the caribou when they know that there's a risk and they all start, booking, they start running for the exit. That's what happens in the market. So that initial whoosh happens. That's what's happening to start the whoosh. The whoosh then continues and gets to a bottom, but before it gets bottoming, what you have is a tremendous unwinding of leverage, because what most of us don't understand as retail investors is that in the markets, whether it be the hedge funds, et cetera, they are tremendously leveraged. For example, if I was a hedge fund manager, I could take $25 million of US Treasuries, use it as collateral. I could go to my prime broker and leverage that up anywhere between maybe 8 and 13 times to 1. So I can make 25 million act like 300 million in the market, but I have a very short window of opportunity to do that, because if the market starts going against my bets and it sells off to a point, the people who lent me that money, the prime brokers, say, you have to sell at all costs because we want to make sure our capital doesn't go to zero. That's why you have that tremendous downtrodden in the market, because a lot of that unwinding happens in the beginning. Then you have a market that starts its bottoming process. You have a bunch of what we call relief or reflex rallies that ensue. They go up drastically, and that's why you see these days where the market's up, like yesterday, 1,600 points in a day. You have markets that down 1,000 in a day, and it's a very bipolar market, we call it, where you have tremendous ups and downs. And then throughout that extent, which is the ups and downs that we have, you have duration occurring, which is the time from left to right. And then over the course of time, these things start to settle out. Then you get usually a bottoming effect, that is the demoralization phase, what we call it, where now all of a sudden the real economic data that comes in as a result of the problem that caused it starts to come in, where we find out the earnings of companies have really gotten beaten up. We find out the GDP of the economy, the unemployment numbers are starting to reflect the problem. And that usually is where the bottoming process starts to really settle out. And then from there, we move forward. If we take a look at what's happened this time, once again, the prior chart was 1987. What do we have? A market that was overbought a bit coming into 2020. We have that crescendo, which is going to be around the 19th of February. Then we had this boom, and you can see it's not quite as drastic as the 1987 crash, because that was pretty much in one day that happened, or a week. This is going to be over a course of some weeks, but you can see it's a similar pattern. And now we're coming back up the other side. I don't believe, which I'll mention in a second, that we've actually are done with hitting the bottoms, whether it's the absolute bottom. We're going to figure that out. This is the last 11 recessions. When we take a look at what's happened with the market and we take a look at the history of it, 1948 through 2007, the things you want to just key in on here without getting lost in the numbers are, there was a time frame, and it was from the peak of the market, which once again, this time was February 19, to the trough, There's just a big question mark there for us now. We don't know where that trough is exactly going to be. How long did it take? So there's your duration. It took 12 months, for example, in this example. What was the top to the bottom? What was the peak to the trough decline? 21%. I bring this up because I look at the average and I say to myself, 30% is the average of all of these times. We've been under that in multiple instances. We've been over that in 4 of the 11 instances. If you take a look at the minus 36, the 48, the 49, and the 57. This is the one we all remember, right? This financial crisis. This is burned in our brains because most of us who are investors, since it happened not that long ago, remember that. And you can see that was very drastic. I'm going to flash over and just show you a daily tracking of what I created to follow this. And it simply shows you in real time what's happened here. Here's that 19th where the S&P 500 was at 33.93. Here's what the point close was of each and every date to its left. And what I just want you to take a look at, if you follow down, is what we were from the high, because that's how the market measures where we are. From this high, what were we down? 12%. Then we got into the next week over here where we're getting into, you know, the 9th, which is going to be minus 20%. Then we had into March 26, 20, 29. You can see this tremendous bobbing. And we've all seen it if you turn on the stock market every day. Where we were at the bottom, which was minus 35. Remember that the average is 30 in my prior slide. That is a little bit more than the average, obviously. And you can see down here, we then recovered. We kind of bobbled up and down. And as of yesterday, we had a tremendous up day. So we are still 21.5%. We are watching technical levels from 2018, which was minus 30. We bounced off those same technical levels. So what we do as market watchers is we just rewind time and say, when's the last time we hit those levels? We kind of ended up at this level, bobbing up and down throughout the 17s, going back to 2016, where we were minus 38. And once again, here's that financial crisis here. So what's the moral of this story as I'm showing you? The moral of the story is that we have a repeat of what's happened in 1987 pretty closely. We know what history tells us when we take a look at where this market usually settles out and starts its bottoming process and then completes its bottoming process. This is an overlay of the 1987 versus the 2020, what we have going on here. The red line is the S&P of what's happening. And this is going back to, I believe, earlier in March here. But you can see here, 1987, it's a similar pattern. So that's where I'm just drawing my parallels to 1987. And the market did rebound fairly quickly coming out of 1987, which is awesome. So I believe that we're going to have this repeat. I believe it may get worse before it gets better. In my closing here, when I say what can we do about it, I'm going to definitely just wrap up by saying here's some things that we need to pay attention. And one of the things you have to be careful of is not getting in too early, but then not also missing some of the bounce here. Okay, so my take on this. When we take a look at when's the turning point going to be in the market, right? Because that's what everybody wants to know. Ian, when does this thing bottom out and what do I do about it? There was a famous investor named Jeremy Grantham, and he had a very famous line. He said this in 2009. Finally be aware that the market does not turn when it sees light at the end of the tunnel. That's when we feel good about it, right? It turns when all looks black, but just a subtle shade less black than the day before. So fast forward to today. What are we starting to see? We're starting to see where the case count acceleration is starting to decrease in the US. We have a playbook somewhat from China. If you believe the numbers, that's a whole nother story. But we do know what happens in Italy. We do believe what happens in South Korea, et cetera. That being the case, we see that acceleration decreasing. We see the death count usually crescendoing. And then we start to see that the slowing of that pace is a very positive sign, right? So it is a little bit less dark than it was. The oil crisis in the background is getting solved, hopefully, if you believe what's happening. Saudis and the Russians have gotten a little bit of a spat about pricing and OPEC and all these different things. We have an oil crisis in this country that has really dipped. And what that means to the US, and this is why I bring it up, is there are estimated, I would say, about 13 million jobs in this country that are around the oil industry, and that we are the largest oil producer in the world. If the prices go too low, it's somewhere in this range where the cost of extraction per barrel for the US producers is about high 20s. Let's call it 28 for sake of example. For Russia, it's in the high teens to low 20s. For the Saudis, it's about $8 a barrel. So if you have pricing on oil that approaches $20 a barrel, it's starting to hurt Russia. Maybe they did this unintendedly. It's definitely not hurting the Saudis quite as much. Of course, they want fatter margins like we all do in our businesses, but at $8 versus 20, we can still make money. Who's it hurting the most? USA. So what we have is these banks crushing the oil producers and extractors, saying, hey, you have to shut your businesses down. You're highly leveraged, all these different things. So we have the COVID problem, which is slowing the economy on the demand side. Then we also have the oil problem, which is shutting down all these oil producers in the south of mostly in the south of the United States. So that's why the oil issue is also on top of this. Moving on to the drug issue. I believe that if you were to take a look and say the program for PPP, for example, is a 2.5-month window. They're going to allow us, give us money to pay our people and keep our rent and utilities on for 2.5 months. If you were to take a look at the unemployment, the extra $600 by the federal government, that gets us to the end of July. If you know how long that lasts, that's what they said. So you start doing the math on that, that's a little bit more than 2.5 months to 4 months. If you take a look at where the stock market is priced today, getting back to where we are, there's no way that the stock and bond markets or the economists are pricing in a death, doom, destruction scenario. It's not Armageddon, because if it was, you would see the stock market sell off precipitously from here. There's no way it should even be close to where we are. I mean, if we are minus 14% from the high, or 20%, whatever you want to say, from the high to keep it simple, then that pretty much has burned off the gains we had in 2020 coming into the problem. And it also burned off 2019 predominantly. But that's all. We aren't going back, year after year or a whole decade worth of growth. And I just don't believe that the market believes, the bond or stock market or the economists believe that this thing's going to go into August where the economy shut down, or September. That's not priced in yet. So my take on that is why I believe that the flattening of the curve through, social distancing or physical distancing, now that we've changed it, people being, not shaking hands, wearing masks and the like, coupled with a drug, whether it's remdesivir, whether it's going to be this hydroxychloroquine, whatever it's going to be, I believe that all the economists in the market believe that a drug is going to come to market and help us. Because if not, you would see death, doom, and destruction priced into these markets. There's no way we would have a 1,600-point up day yesterday. Things would have come down precipitously. So as we go through, what do we do as an investor, right? What can you do about these things? There's a general who has a consulting group. He's the one who preceded Mattis, who is no longer with the U.S. government now either. But General McChrystal has a consulting group, and he basically says when he sits down with a business owner who's consulting him, he said, listen, you have to ask yourself 2 questions. What is happening, and what can I do about it? So we just went through the what is happening. Now we're going to the what can we do about it? The first thing I would tell everyone is hope is not a strategy. When it comes to your retirement, when it comes to your business, we can't hope that things are going to come back. I hope that we get a drug that shortens this time frame for all of us. I can't bet on that though. What I can do is get a plan around this, and I can base case it. I can come off my base case to the worst side, and then I can best case it. I would suggest all of you do the same thing. So as it relates to your retirement plan and your other investments, if you don't have a plan, make sure you get one. Make sure then if you do have a plan that needs to change, you change it. Maybe you were too risky and you need to free up some money. We suggest 2 years, which I'll touch on. But if your plan makes sense for you and it's highly diversified like it should be, and it works for you, make sure you stick with it. Because at times like this, it can be unbelievably difficult to deviate from your plan. If you want to contact us to talk about a plan, and Ian, does my plan make sense? We are here for you. I just want to throw that out. This is the time when things like bonds, permanent life insurance cash values, having equity in your home, not being over leveraged and having tons of debt otherwise. These are the times when all of this makes a lot of sense. These things are never sexy when the market's doing well, but in times like these, you're happy that you have this and you can weather the storm. The second thing I would suggest to all of you is understand a little bit about history, because if we've been here before and we know what it feels like, it's not this shock and awe as much and this deer in headlights feeling. Know that liquidity is important. The only people that have gotten wiped out in their businesses, wiped out in the stock market, wiped out in any type of real estate investment are the people who could not weather the storm. So that happened in 2008 and 2009. Anybody who got through that, whether you are any of those investors and you could weather the storm because you had the liquidity, is my message, then you made it to the other side. And in fact, you probably made a lot of money if you stuck with your principles and stuck with your plan. The same thing in 1987 that I flashed up earlier. And you can go through the Depression even. As long as you can make it to the other side, all of those people make money. The only people that get wiped out that you hear these stories about, because we've all heard them, are the people who couldn't weather it. When talking about the stock market, don't try to be too cute. Note that even if you pick the exact wrong day in the stock market, it was okay. You had to wait longer, 7 years from August 2000, if you picked the absolute wrong day until until it recovered earlier in 2007. Then if you get to the worst day here for the financial crisis, right? 2007 to the other side was March 2013. It took 5.5 years. So even if you pick the wrong day, if you have time on your side and you're younger and you're hearing this webinar, please stick with your plan. It will always work out. And I'm going to give you a feels better slide at the end of this that I think will make you feel really good about why you're sticking with your plan. One of the things I just wanted to also show you that I think is important is what missing out can do. Because once again, it's very easy to come off your plan. It's difficult to stick with your convictions when you're staring in the face of this market that's taking your capital away and you're watching your accounts come down. All this simply shows is that if you had $10,000 invested January 1, 1980, and then you said, I'm invested all days, that would have gotten you to a $708,000 total on your account if you just let it continue to compound and you stayed invested through the ups and the downs. If you missed only the 5 best days, your total wouldn't be 708, it would be 458. That's the drastic difference between missing 5 days since 1980. If you miss 10 days, it gets worse. If you miss 30 of the best days, it gets worse. And if you miss 50 of the best days, you pretty much haven't grown your capital, but comparatively speaking. So I mention this because when do the best days come? The best days usually come in a bear market. Days like yesterday, couldn't be more appropriate. Dow was up 1,600 points. Those kind of days don't come in a bull market. They come in a bear market because there's a tremendous difference of opinion at the bottom of when is the bottom, and people jump in and overbuy and they oversell. So please stick with your plan, stick with your convictions. Make sure you have 2 years of liquidity. So all the above assumes that you at least have a couple years of liquidity. So Ian, should I have that much in my bank account? I don't have 2 years in my bank account. Oh my. That's not what I'm saying. What I'm saying is have a place to go. It could be the money in your bank account. It could be a home equity line of credit that you have on your house. It could be that you have bonds inside of your non-IRA investment portfolio if you're under retirement age. It could be the bonds in your investment portfolio if you're over age 70. The things that are safer, the things that have less volatility, utilize these things even though it may not feel that comfortable sometimes. If you're investing, old money is the money that's in the account. New money is the money that you're continuing to put in the account. Like, for example, the contribution of your paycheck for your 401k. The old adage today, which is a new adage, is going to become old. Treat it like your face. Don't touch it, right? They're all telling us not to touch our face. Don't touch your retirement plan. Keep it there. If it's stay invested. Like I said, timing can be difficult. The new money, I get a lot of inquiries. Ian, I'm systematically investing in my account. I'm systematically investing in my 401k. Should I continue? The answer is yes. You want to buy low, right? It's difficult to do that when things are low. We all know that in a vacuum, but these are some things that we want to talk about. Keep on investing. Resist FOMO, right? Fear of missing out. If you have cash off to the side, continue to hold on to that cash and wait for some dips in the market. And if you see these 1,000-point down days, put a little bit of it in. It doesn't mean you put all of it in. It's likely that you haven't missed the boat yet because we don't believe that we've seen the bottoming process play through. We are going to maybe test those bottoms. I can't say that we'll get to minus 35% again, but as you see this thing come down, pick some days if you want to try to semi-time the market on little bits of capital that aren't invested. But please don't go chase a 1,600-point up day because you think you missed it. Chances are you didn't. Lastly, if you're in the distribution phase, and that would be for some of the people on this call that maybe are living off their portfolio. Maybe they sold their business to their children, or, maybe you just have a pile of money and you're getting to that phase of your life where you're living off your money. Keep your expenses low during this time frame. It's likely it's going to be fairly short. And when I say fairly short, like less than a year that you need to do that. Taking out less at the bottom always makes sense because of the money that you believe in can recover then. And then understand the value of what we call a volatility buffer. Once again, if you have cash values in fixed life insurance policies, maybe it's time to consider those for income producer principles. Home equity lines of credit. I know this is scary for some people. If you don't have one, go get one. This is one of the best, what we call volatility buffers there are. Use that money to live on if you have to in a pinch. Give your portfolio some time to recover, right? So we're just trying to look and buy time to make sure that we can get to the other side. That's all about this liquidity. And if any of you have questions on that at the end here, I'll give you an opportunity to reach out to us. We'd be happy to help you. I think this is very appropriate. We all came into this year, most of us, it's been so good for so long, right? 2009 is a long ways away in our mind. And we thought that our plan was just going along, right? We're just pedaling along. And this is what many of us think our plan looks like. The reality of it is that oftentimes it looks like this. And this is a cute little slide I show many of my clients. The moral of the story is be prepared for when these things come to make it to the other side. So I'll close here. If there's any chat questions, if Mike doesn't have to jump on right away, more than happy to help each and every one of you get to the other side. And if you need a plan or if you want to contact us, there's the email address at the bottom to shoot for. We're happy to help. Thank you.
Oh, thank you, Ian. Hey, there is one question here, and I know it's a kind of a broad question because, well, let me read it first. What is your opinion on selling a business during this time? Is it a favorable time or unfavorable? Now, we don't know if we're talking about third-party sales or in-family sales, but do you want to just comment on that a little bit? And Mike might have a comment too at some point.
So I know part of Mike's presentation is going to talk about, if you are going to be selling that to a family member. So I'll let Mike address that. But here's what I would say. I mean, what is the value of your business right now? Typical measurements are used, as Mike will get into, on how that's done. And the valuation, people use that. The IRS then takes a look and says, we're going to use traditional metrics to value. Once again, I'll let Mike answer that in depth, but it may or may not be a good time depending upon what you're looking to accomplish. I mean, if it's an outside buyer and you're looking to get top dollar, chances are now's not the time just because of what's going on. But once again, I don't mean to dodge the question. Mike can answer that more fully.
Thanks, Ian. Okay, Mike.
Hi, can everybody hear me? Great. Jared, could you put my slides up, please? Great, thank you. So what I would like to talk about really are two things. Number one is sort of the urgency or the advisability of having a plan in place. And I'm talking about your estate plan. And secondly, the opportunities that exist for really good advanced planning, especially for family business owners in a COVID-19 world. It's sort of interesting as we sort of look at our client base, there are certain people, and I think a lot of it is personality based, who are in a sense somewhat paralyzed by these crises. And really can't think about anything or doing anything. And we see other people who pick up the phone and call us if we haven't called them first and say, hey, what can we do here? This is, possibly a great time to transfer for wealth. What advice do you have? So we're going to sort of focus on 3 points that we think are advisable for people to consider in this COVID-19 world. But first, Ian, or Jared, rather, if you can advance to the next slide, please. So this is sort of an excerpt of a news article we saw the other day, and I've seen, probably because I work in this space, but I know that the Philadelphia Inquirer had an article similar to this. This one happened to be at Bloomberg, out of Bloomberg News, and there was one in the New York Times the other day. One of the interesting things about these crises is this particular crisis is it has really prompted a lot of people to pick up the phone and call us and say, hey, Mike, we met 18 months ago and we never made any progress on our estate planning documents. Do you think we can do something now to get at least something in place if, God forbid, something were to happen? And some of our clients are on the front lines. They're doctors. So they have a real fear about something happening to them. And other people are just people who, frankly, who've neglected this aspect of their lives and suddenly have a lot of time on their hands to deal with these things. But the point is it's, it's good to have these things in place. And from our standpoint, a lot of this stuff can be done remotely. The typical components of an estate plan are, at least in terms of written documents, a base plan, are a will, possibly a revocable trust, an advanced healthcare directive, and a power of attorney. The only document that requires a notary is a power of attorney. And on late Friday, Pennsylvania law has been modified temporarily to permit remote notaries. So the concept is you can get a lawyer and a client and a notary on a video call like this, and as long as the notary can satisfy themselves that the person who's signing the document is who they say they are, we can proceed to sign all of those estate planning documents. And I think that's going to be, in some respects, the way we do business for the next couple of months until we can meet in person with our clients, especially a lot of our older clients. So don't think that if you don't have your affairs in order, don't think that, or your clients don't have their affairs in order, don't think that lawyers are sort of closed to business these days. A lot of this stuff can be done remotely. So, it is something, especially if you have some time on your hands, that you can think about, checking the box on this type of project and getting it done. Jared, could you advance to the next slide? So sort of going into planning opportunities, before this whole COVID crisis hit us, 2002 we viewed as a very important year for planning. And there are really three reasons that we viewed that 2002 as a good year, a good opportunity to do advanced planning. And here we're talking not about getting your base documents in order, but we're really talking about advanced planning in the family business context and in the high net worth space where people are looking to transfer assets to next generations. The first opportunity that exists in 2020 is the fact that we still have these high exclusion amounts that are available for gift and estate tax purposes, and they are currently in the $11.5 million range per person. These exclusion amounts were enacted in 2017, and they are set to expire on January 1, 2026. The other big issues that we're facing, obviously, in 2020 is the possibility that the elections could accelerate the sunset on these exemptions. And all of the Democratic presidential candidates have publicly said that they want the exemptions to go down to the range of $3.5 million. So you're looking at possibly the elimination of a significant estate planning opportunity if, in fact, both the presidency and the Senate were to flip from Republican to Democrat. And the last opportunity that existed in 2020 pre-COVID was the fact that interest rates were extremely low. And this allows for a lot of intra-family transactions where we can take advantage of low interest rates. Number one, possibly lending money to family members and taking back a note at a low interest rate. And number two, selling your business on an installment sale basis, meaning not for cash, and taking back a note with a low interest rate as well. Jared, could you advance the slide, please? So how did COVID change things? There are, I think, three very significant things that happened because of COVID. Number one is that interest rates have fallen even further than they were a month or two ago. So now the midterm applicable federal rate, which is the rate that the IRS requires people to charge on a loan, the minimum rate that's required, and the midterm is for loans greater than 3 years but less than 9 years, is now less than 1%. So you can basically sell an interest in a privately held business to a family member and take back a note that bears interest at a little bit less than 1% if it's payable in less than 9 years. Number two is the decline in publicly held equity and fixed income securities is presenting a planning technique that we'll talk about a little bit later, planning opportunity that we'll talk about a little bit later, and is also, as Ian suggested, is affecting the valuation of privately held businesses, and thereby presenting us with another planning opportunity in terms of transferring family businesses. And the last thing that I think a lot of people are asking is, you know, all the COVID relief that has taken place is obviously terrific for our citizens and especially for our small business owners, but ultimately somebody's going to have to pay for that. And the way that we're likely going to pay for that is through increased income taxes and possibly even Republicans relooking at these estate tax exemptions and estate tax rates and considering whether there's a source of revenue there that we can, for lack of a better word, seize to, you know, to pay for the relief that we're offering. So, Jerry, could you advance the slide? So I'd really like to talk briefly about three specific planning opportunities that might be worth considering in this market. The first is a Roth IRA conversion. The second is a gift or a sale of an ownership interest in a privately held company. And the third is something called a grantor retained annuity trust. And Jared, if you can advance this, we'll start with a Roth conversion. So, you know, a Roth conversion is, as everybody knows, is the opportunity to convert a traditional IRA, which requires, number one, minimum distributions during your lifetime and taxes each of those minimum distributions, to convert that to a Roth IRA, which does not have required minimum distribution during your lifetime, and which allows all distributions to come out, whether during your lifetime or after your lifetime, to come out income tax free. And the toll charge for converting a traditional IRA to a Roth IRA is that whatever you convert, you need to pay income tax on in the year of conversion. So, and Ian, feel free to jump in with any of these points because this is the world you live in. You know, as lawyers, estate planning lawyers, our job with respect to these identifying planning opportunities in the world of Roth conversions is simply to identify the possibility of this as something a client may want to do, and then to turn you back to your accountants and your financial advisors to actually run through the calculations and see if it makes sense. But generally speaking, the factors to consider, and you'll see how all of these exist in today's environment about whether it is an opportune time to convert, is number one, is the account balance at a relatively low value relative to where it's been or where you expect it to go. Number two, as I just mentioned, do you expect the account balance to increase in value in the future? According to Ian and history, it will. Number three is what's your income tax rate in the year of conversion? That's something I think incredibly important to consider in the current year. Number one, we don't know where income tax rates are going to be next year. Number two, for a lot of owners of closely held businesses, the idea that you could have shut down your business for a couple years, or a couple months rather, within this year, could impact the compensation you take out of the business, could impact the earnings that are distributed to you out of your business. So will 2020 be a year where you are in an unusually low income tax bracket? Number three, what will be your income tax rate when you withdraw the funds? Do you expect it to be higher than it is today, or you expect it to be lower than it is today? If higher, then conversion would seem to be something you'd want to consider. And the last important point is, will you really need your IRA in retirement? We find a lot of business owners, family business owners, closely held business owners, put money away to save in an IRA because it's a prudent thing to do, but don't end up needing the IRA to live on because maybe they have proceeds from the sale of the business or non-IRA assets that they are living off of. So they never need to take money out of the IRA. And in fact, the only reason they take money out of the IRA is because they're required to under the required minimum distribution rules. So this could be a year where you meet with your financial advisor, your accountant, and you talk about the possibility of a Roth conversion. And I think one thing that's really important to consider is that this is not an all or nothing proposition. No one's telling you that you have to convert your entire traditional IRA. This is something you can bite off in pieces. So again, something to consider for this year. Ian, you have anything to add to that?
I think you covered the bulk of it, Mike. I mean, the only thing I would say is it's got to be part of its strategy. You know, what are you trying to accomplish? Why are you trying to accomplish it? And when are you trying to accomplish it? And I say it that way because most people approach me about the Roth and say, Ian, Roths are the most incredible thing in the world concept. Whatever it takes for me to get there, let's just get it done. That may or may not make sense in this current year, as Mike's saying. So I think it's got to be part of a strategy. And most oftentimes, I'll share this, that I'm dealing with the CPA of the business owner or the client in this case and say, how much of it do we convert this year to keep under some certain tax thresholds, given your already income tax situation for the year? So it's usually not a all in 1 year kind of thing. It's usually a piecemeal over time, and it just got to be part of a bigger picture strategy. So there was a lot of thoughtfulness that should go into that decision.
Great. Thank you. The next item that I'm sure is and touches on the one question that was asked in Ian's section of the presentation is, this is an incredibly interesting time to consider the transfer of an ownership interest in a privately held company. And you know, as I thought about this presentation, my planning opportunity was really geared towards an intra-family transfer. And the idea that we're always focusing on is the best time to transfer, all things being equal, and assuming the senior generation is not looking to, the transferring generation is really looking to transfer the business interest at the lowest possible value, meaning they're not really looking to the proceeds from an intra-family sale to live off of. COVID has really done a number on valuation when it comes to privately held businesses. So number one, remember, a transfer of a privately held business can be done by either gift or sale. And the big issues now affecting the valuation of these interests compared to what they looked like a month ago is that we're, obviously experiencing a great deal of market volatility right now. And from a valuation person's perspective, and I know we have a couple valuation experts on the call here, at least one, is that market volatility typically means that greater discounts are available in terms of valuing your business. So typically the way a business is valued for purposes of transferring it between family members is the historical earnings stream is evaluated. There is a multiple applied to that historical earnings pattern. A value of the business of the entire business enterprise is ascertained. And then when partial interests in that business are valued for gift or transfer tax purposes, there are discounts applied to that partial interest in the business. The first discount that is applied is based on the fact that if you're gifting or selling a partial interest, that the person buying it doesn't have the ability necessarily to control the business. So there's a control discount that is applied. And the second discount that is applied is a discount for lack of marketability. The idea that the person who's buying that business interest can't turn around and liquidate it in the marketplace like you could liquidate a publicly traded security. So in these periods of market volatility and sort of the desire of a lot of people to hold cash as opposed to an illiquid investment, higher discounts are generally available for lack of marketability. In addition, before that lack of marketability is even applied, the multiples that are applied to determine the enterprise value are greatly reduced, really because the multiples that are applied to privately held companies are derived from multiples of publicly held companies. So if the value of a publicly held company goes down, then the value of a privately held company will also go down because that's where the multiples are derived from. And finally, forecasts look a lot different now than they did a month ago. So if you're thinking about transferring a business in a privately held company to the next generation, and you're going to use 2020's earnings as one of the years of earnings that you're going to use to evaluate the value of that business, and you're only going to have 10 months of earnings as opposed to 12 months of earnings because your industry's been shut down, this could be, a very, very unique opportunity for you to transfer your ownership interest in your business at a very low value. Now, to the question that was asked earlier, this is a great time to transfer an interest in a closely held business, intra-family, if you don't care about what you get in return. If you are looking to exit the business to a third-party buyer, it may not be the best time in the world for the exact same reasons that we just talked about. Now, one thing I did not mention, and I should mention, is that all of this is sort of industry specific. There are people out there who are killing it in this environment because of the particular industry that they happen to be involved in. There are other people who are shut down. So it really depends on the nature of your industry in terms of, and who the potential buyer is and the purpose of the sale, about whether this is a good time or a bad time to sell your business. Maybe Ian, you can comment on how much cash is going to be available in private equity after all of this is said and done. Is there more cash? Is there less cash? Are people going to be looking for privately held companies? What typically happens?
Cash, period. Listen, private equity companies are usually highly leveraged. The friends that I have in that industry and the folks that I've spoken to, and this is all relative to each other, but some of them are in better shape than others. And oftentimes they buy companies on a leverage basis and they may be hurting. The issue with private equity is that everything they invest in is usually highly illiquid. So they have to get to their whatever their liquidity event is. And that could be a 3 to 5 year window. So, the good news is, to help that whole issue, interest rates are unbelievably low. So if they're borrowing at LIBOR or borrowing at any interest rate relative to what it was, those interest rates are low. So the answer is, Mike, I don't know how that's all going to shake out. I think that some, like all of our businesses, some are going to thrive, some are going to do okay, and some are going to get wiped out. But, theory says that there's going to be money out there, in that system, from some parties.
Yeah, so my advice in terms of, if you are in the process of it, there is no harm in continuing going through that process and see what kind of opportunities you can get from a third party, offers from a third party buyer, as long as you're not, I guess, emotionally invested in getting out, because it might not be the right time to get out depending upon your particular industry. Jerry, could you advance to my last slide? So the last thing I want to talk about is a very simple estate planning technique that that we are doing a lot these days, and I mean a lot. There is a simple estate planning technique called a grantor retained annuity trust. And what is a grantor retained annuity trust? Simply, it is a technique for transferring the future growth on assets to your heirs without making a gift for gift and estate tax purposes. And the way it works is this, very simply, is that a donor, the person intending to make the gift, makes a gift into a trust that lasts for 2 years. And there are two important parts of the gifts. The first important part of the gift is that the donor is entitled to get back everything that he or she contributed to the trust at a predetermined annual IRS interest rate. And currently that rate is at close to the all-time lows, if not the all-time low, of 1.2%, okay? That's number one, is that there's a transfer into the trust where you get back everything that you transferred in plus the IRS interest rate. And that's why there's no gift for gift tax purposes, because you're getting it back everything that you're entitled to plus interest. Secondly, the second part of the trust is anything that's left in the trust at the end of the 2-year term will go to your heirs, and that's determined by whatever you put in your trust document, but typically it's your children. So the goal here is to outperform this IRS interest rate called the 75/20 rate. So in times when publicly traded securities are valued low, what people are doing, by way of example, would be you would make a gift of $1 million of your publicly traded stock that you feel is undervalued at this point in time. If the value increased by 10% for the next 2 years, the result would be that under these economics and how the interest rates currently play out, is you would get back your $1 million plus $19,000 of interest, and your heirs would end up getting $145,000 in their pocket if there was a 10% return for each of the next 2 years. So you've been able to transfer $145,000 of wealth without using up any portion of your currently $11 million gift tax exemption. So when values of public securities are low, this is the perfect way to transfer appreciation in those future appreciation in those securities without incurring any gift tax or using up any of your gift tax exemption. And the important thing from our standpoint, it's a technique that's blessed by the IRS. There is very little risk involved in doing this. So with that, my presentation is concluded. I hope you take advantage of this time, you get your documents in order, and my advice is don't be paralyzed by this time, but look at it as a tremendous opportunity to help your family out if you haven't already taken steps to do so.
Well, Mike, thank you so much, and Ian as well. And we will be sending out a follow-up that will have both the documents that they both presented and the recordings. And as they both volunteered, please reach out to them if you have any other questions. Also want to bring to your attention, we have Thursday morning at 9 o'clock, a webinar responding to your COVID-related family business questions. We'll have Bob Meehan and Bob Nagel on from Fox. And then on Tuesday, April 14, the webinar will be how your family business can adapt to create sustainability. And that will be with Paula Barrett and with Ryan Hurst from RKL. So also, please feel free to visit our webpage on COVID. It has all of our advisors, our EDU sponsors, resource centers on there that are constantly being updated. And we'll look forward to seeing you Thursday, and just reach out as you need. So blessings to all for your day. We'll talk soon.